Can you explain from a psychological standpoint how you hold yourself together knowing that most of your wealth is held in these equities that are probably down, 40 to 60% on any given stock?
I mean, one is just perspective. I'm in my early 30s, just turned 33 recently. I plan on being a net saver for, another 10, 20 years probably. So I think I'm just constantly in the phase of, as Buffett likes to say, the idea of buying hamburger meat cheaper than you were yesterday. Nobody complains when they're doing that. And that's kind of how I view the opportunity to buy, additional shares of the companies I'm invested in. So that's really how I think about it at a high level. And then again, I know the prices move around very, very significantly, but I have a minority ownership position in these businesses. And I think I certainly had periods in the past where I held more cash. I think I've always had the perspective that when you get past 10, 15, 20% cash, you're getting into this dangerous territory where you can really become someone who's market timing, for lack of a better term. And it's something I've always wanted to avoid. I've become stricter in just saying, cut the cash almost to zero, because one, I think it's the right decision over the long term in terms of where my dollars will be. But two, I also think it changes the way that you think about the decisions you make in your portfolio and how you think about opportunity cost. A good example is right now when stocks are going down a lot. You have cash sitting on the sideline, it's fairly easy to say, I've been waiting to buy XYZ at a 20% discount to where it was at. Now I have that 20% discount to where it was at. That decision is a lot harder when you look across your portfolio and go, well, to fund that, I have to sell something that's down 25%. And I like these positions as well. I think the bar is raised a little bit in terms of that decision, but I think it also probably leads to more thoughtful decision making, because you may need to look at something and go, I know this is down, but I need to sell this to buy what I think is objectively a better business. So I think it just raises the bar in terms of your decision making. But yeah, a lot of this has been an ongoing evolution. And I think that's an important part of being an investor as well. And I think one thing to avoid as an investor, and something I try to do better at every single day, is picking up learnings from people who don't see the world exactly as you do or play the game differently than you do. And I think there can be a lot of value in that, even if it never directly translates into how you make your own decisions.
Reading through your investment philosophy, I absolutely loved your metaphorical depiction of how you invest, specifically the quotes from Stan Druckenmiller and the anecdote from Charlie Munger. Can you expand on that a little bit, and particularly how you view portfolio construction in general and also your investment process?
So at a high level, I start from the perspective of asset allocation, and really the idea of being a structural allocation in my portfolio, meaning at any given time, I'm not changing my stock bond allocation. Given my age and kind of how I think about what my savings rate will be going forward, I'm pretty comfortable with, call it a 95 to 100% equity allocation. So that makes life really easy in terms of basically never holding cash and always just thinking about opportunity costs in terms of the watch list or the names that I currently own. The alternative would be a bit more tactical, which say you could say, hey, I'm a 70-30 investor, but based on the market environment, I might go 50-50 or 90. I just think you get too much into market timing, and it's kind of a distraction in a lot of ways. And it's just very hard to do well over long periods of time. And I've seen that personally, and I've seen it with clients in my old role as a kind of investment advisor. I run a concentrated portfolio with a small number of positions. I think I have 13 holdings currently. I just think about those as, in the kind of the context that Charlie Munger has said before, if you own a local McDonald's franchise, you own a gas station, you own, one or two other businesses, I think anybody would reasonably look at that and say, yeah, you're diversified in terms of your holdings as a business owner, especially if they weren't in the same, geographic region. And that's really how I think about it. I mean, Microsoft is a diversified business in its own right and has a very strong balance sheet. And if I own Microsoft, Berkshire, Pepsi, and, one or two other stocks, from the perspective of a business owner, I think it's pretty clear that that's fairly well diversified. And, I just kind of approach it with that same thought process. That also obviously introduces some risk of pretty significant volatility and returns that deviate from the market pretty significantly. But if you're an active investor, that's kind of the cost of any shot about performance requires the risk of underperformance during periods of time.